Hi, Daniel here. In today's video, we'll be looking at the basics of a financial crisis and how you can prepare and protect yourself against one. In particular, we'll be looking at what a financial crisis is and also the anatomy of a financial crisis. We'll also be going through a case study of the year 2000 dot-com bust and draw parallel between the past and the present. Last but not least, we'll look at how you can position yourself and prepare for a financial crisis of the future. Without further ado, let's get started. What is a financial crisis? A financial crisis occurs when the financial instruments and assets like your stocks, bonds, and real estate decreases significantly in value. A financial crisis is often associated with widespread panic, during which investors sell off their assets because they fear that the value of those assets will continue to drop if they remain invested. Though not exhaustive, the cause of a financial crisis can often be traced back to two main sources. Number one, unsustainable prices caused by investors either from their blind investments or excessive speculation. Number two, systematic failures caused by unsustainable business models and operation. To understand how you can spot and prepare for the next financial crisis, you need to first understand the anatomy of a financial crisis, which brings me to my next point. The anatomy of a financial crisis. So what are the recipe and steps to cook up the perfect financial crisis? While every financial crisis is nurtured and imploded by different factors of their respective times, there are common characteristics, patterns, and phases that the economy or market goes through before the eventual crisis occurs. You need to have a good understanding of each phases for you to be able to spot and prepare for the next crisis while it is still brewing. So every good financial crisis story has two parts, right? The first part is the nurturing part, and it begins with a positive external shock that increases optimism of the market participants towards the economy. And that results in actions that causes the economic progress to become unsustainable. The second part is the imploding part, and it begins with the realization that the economy is unsustainable and that things need to come back down to normal levels where it is healthy for any future economic progress to be sustainable. To give you an analogy, the first part of a financial crisis story is kind of like when you started to lose control of your diet, right? Which result in massive weight gain and even obesity. But you simply don't care because the food is too good to not consume. The second part is kind of like the shit hits the fan moment when you suffer from a heart attack, which made you realize that your actions today are not sustainable and that you need to cut back down on your diet and start exercising to prevent your premature death. So that's kind of like what a financial crisis is, and with that out of the way, let's go through the first part, the nurturing of a financial crisis. Part 1. Nurturing a financial crisis. The first part of brewing a financial crisis is the nurturing part, and it begins with a positive external shock that increases the optimism of the market participants towards the economy. For a newfound mentality that the economy is going to be stronger than ever and that they are going to do well financially, people will become more willing to consume, spend, borrow, and invest. And as a direct result of the market participants' action, the economic activity starts to increase and the growth rate will start to accelerate. This reinforces the market participants' belief that the economy is doing well and will continue to perform indefinitely. And because of that validation, the market participants now become even more aggressive with their consumption, spending, borrowing, and investments. And that's how the positive feedback loop begins. In moderation, the increase in consumption, spending, borrowing, and investments of the market participants are healthy and even necessary for sustainable economic growth to occur. The problem comes when the market participants get a little bit too greedy and goes above and beyond their means, in a sense whereby they are spending more than what they can afford or taking on more risk than what they should be taking on in the very first place. When market participants like your investors, businesses, and consumers get overwhelmed by the ongoing hype and euphoria, it creates an environment for widespread negligence and even fraudulent behaviors that creates unsustainable economic conditions that are extremely fragile and destined to collapse. On average, periods of euphoria can last up to 3 to 4 years. Hence the saying, of the market can remain irrational longer than it can remain solvent. Now that the economy has become the equivalent of a house of cards, all you need is a small push to topple the entire structure. And that brings me to the second part of the anatomy of a financial crisis. Part 2. Imploding back to normalcy. Just as trends die down, the hype and the euphoria experienced by the market participants today will eventually slow down and come to a halt, as people start to realize that the existing model that the economy is running on is simply not sustainable. This realization can be one that is internal, where market participants slowly realize it themselves, or it can be external, where an external event forces the market participants to acknowledge the reality. When that happens, market participants will become less aggressive and more defensive with their consumption, spending, borrowing, and investments. The change of mindset from confidence to pessimism is the source of instability in the markets. Investors will start to sell off their risky investments and move into safer asset classes like your government bonds. And businesses will start to slow down on their investments as well to avoid taking on additional risk. As a result of this increase in the selling pressure and the decrease in investments made by both business and retail investors, asset prices will start to decrease. The first party to feel this pinch are the highly leveraged investors and businesses who borrow to invest, as they may be unable to meet the sudden margin call as a result of the decrease in asset prices. As a result, they may be forced to sell their investments or even file for bankruptcy. When that happens, asset prices will continue to decline further, and this will trigger a race out of riskier asset classes like your stock and real estate and into safer asset classes like your bonds and deposits. As investors realize that the asset prices are unlikely to increase further in the future and that they should sell off first before things get worse. In times where asset prices are declining with no end in sight, banks will also become more cautious in terms of their lending. The sudden tightening of the supply of credit will lead to higher bankruptcy and greater panic, as people who were previously dependent on the bank's credit for liquidity are now in trouble. The panic will continue to feed on itself until prices have declined so far and become so low that investors are tempted to buy the less liquid assets. Or until the lenders of last resorts like your government and central bank succeeds in convincing investors that the money will be made available in amounts needed to meet the demand for cash. Typically, a financial crisis might last on average 18 to 24 months, with asset prices falling about 30 to 50% over the course of this duration. Now that you have a general understanding of the characteristics, patterns, and phases of a financial crisis, let us take a look at an example of the past financial crisis and see how this model can apply. In particular, we'll be examining the year 2000 dot-com bust, given the parallel of what has happened in the past and what is currently happening today. As I've explained what has transpired in the dot-com bust, I want you to think about what you are experiencing today to see if you can draw any parallel between the past and the present. So let's get started. Year 2000 dot-com bust. Now, the year 2000 dot-com financial crisis story is a story of paying too high of a price for a business model that is unsustainable. The rise of the use of the internet was the external trigger that caused the increase in optimism and hype and started the entire positive feedback loop. The hype and optimism surrounding anything that associates with the internet led to a huge influx of investments in companies without proper business plan, product, track record, or even the most basic profitability. Despite having nothing to show for, the stock of companies that associate themselves with the internet often increased up to 400 to 500% over a short duration of time, thereby attracting more retail investors to invest in hopes to make a quick buck. Eventually, as the broader economy started to slow down, people started to realize that they are investing in unsustainable businesses and paying too high of a price for something that may not even be worth as much. As a result from this realization, investors started to take profit and the share price of stocks started to drop. At the same time, banks also started to stop lending money to tech companies that have no proper business model and track record. Eventually, because of this tightening of the supply of credit, it killed off businesses that have an unsustainable business models, and companies started to file for bankruptcy, which further fueled the panic and accelerated the race out of stocks. After 24 months of price decline and a 50% decline from the previous high for the S&P 500, the dot-com financial crisis eventually came to a conclusion as investors are once again investing again, given the attractive price levels and valuations following the crisis. That covers the 2000 dot-com bust. So what's happening today? Having gone through the dot-com financial crisis story, doesn't it sound familiar as to what is happening today? While the scale is of course different as compared to what has happened in the year 2000 in terms of the number of unprofitable businesses with unsustainable business model, the action of the investors today is somewhat similar to the action of the investors back in the year 2000. As a result, valuations are at an all-time high as people are pricing for perfection, with the new narrative today being the post-pandemic recovery instead of the rise of the internet, right? Now, while there are no guarantee that this will, result in the next financial crisis, we cannot ignore the fact that the probability of the next financial crisis happening is increasing because of the actions of the market participants today. Nothing good ever happens when people blindly invest in things without taking into account of the price that they are paying for and the worth of the things they are investing in. Instead of trying to predict when the next financial crisis may happen, a better option for us is to think about how we can position ourselves and prepare for the next potential financial crisis based on an analysis of the probability of its occurrences given the current market situation. So how can you prepare for a financial crisis? If, based on your analysis, you feel that the current economy and market situation is one that may not be sustainable, what should you do? Now, just as you would fold in a game of poker when the odds are against your favor and raise when the odds are in your favor, investing in times of uncertainty is no different from professional gambling. It is all about taking the right actions to position yourself accordingly based on the probability of profit and loss. If you feel that the current economic and market situation is not sustainable and that the probability of a financial crisis is increasing, what you can do is to reduce your overall risk exposure by selling off the riskier investments and transferring it to a safer asset classes. If you do that, and in the case where you are correct and a financial crisis did happen, you will not suffer the full forces of the investment losses, as now only part of your portfolio is exposed to the riskier asset classes, which often falls about 30 to 50% during a financial crisis. That is what we call risk management, and of course it is impossible for me to go through the details as to how you should go about navigating your investment operations. Which is why I have already created a playlist where I go into details as to how I manage my own investments and how I go about conducting the fundamental and technical analysis. I will link it in the playlist at the end of this video, so do check them out later. Summary. Long story short, while every financial crisis is nurtured and imploded by different factors of their respective times, there are common characteristics, patterns and phases that the economy or the market goes through before the eventual financial crisis occurs. Most financial crises start off with an extreme optimism and hype caused by an external trigger which pushes the asset prices to unsustainable levels as the market participants become more negligent as the day goes by. As the optimism and hype dies down, people will start to come back to their senses and realize that the current asset prices and economic structure is not sustainable. When that happens, people will start to sell off their assets, which causes asset prices to drop. Right? While it is impossible for us to identify with precision when a financial crisis may occur, it is very much possible to position and prepare ourselves for a potential financial crisis as we identify the signs of a potential crisis in making through our analysis. That's all I have for this video today. If you found my content useful, do drop me a like and subscribe to this channel. In next week's video, I will be exploring the common investment biases and why common sense in investing is not that common. So do subscribe to the channel to stay updated with the weekly upload. Also, comment in the comment section as to what topics would you like me to explain and voice my opinion on next. If you'd like to find out more about how you can leverage my experience and benefit from my financial planning services, you can find out more on my website or reach out to me directly on LinkedIn. All the links will be in the description below. Stay safe and I hope to hear from you soon.